Be Wealthy and Smart, episode 1305.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to answer the question, should you invest in a CD at around 5%? Because a lot of people are saying, hey, these interest rates look pretty good. Should I just put my money in a CD, sit out all of the stock market volatility? What do you think? Well, first of all, CDs and stocks are two very different animals. CDs have some good qualities, and that is that you're able to lock in an interest rate. And right now, with interest rates being higher than they'll likely be in a year or two, that's a pretty good idea. Their principal is also guaranteed, so you have no fluctuation of principal. However, should inflation come back, you're locked into that interest rate and you don't have any inflation protection. Also, if you want to get out of your CD before the term is up, you'll lose all the interest that you would have accumulated on the CD, so you don't have liquidity. But the kind of money that a CD would be good for is money that you don't plan to use for a year or two. Money that you don't want to take any risk on. Maybe money that you're saving for a down payment on a home, for example. Something that you know you're going to need short term and you really don't want to have any fluctuation of principal. Also, if you're an older person and you're close to retirement, this might be something that's interesting to you because you can get 5% interest, generate some income, and you're taking less risk. Conversely, if you're a younger person, it's probably not the right thing for you because you probably have 20 or 30 years till retirement. And even in retirement, you're going to want some growth. So you're going to want to invest in something that could get possibly higher returns than 5%, but will entail fluctuation of principal. If you've read my Wealth Heiress book, I've talked about the wealth building formula McT, which is money, compounding, and time. The money that you have to invest will compound depending on what investment you put it in. And if you put it into a stock-oriented investment, like the S&P 500, then you have a chance to earn 10% year in and year out, the long-term growth rate of the S&P 500. And the longer the time you have to invest, the more that it will compound for you and the more growth it will create. For example, if you had $100,000 to invest for 5 years at 5% in a CD type investment, your $100,000 would be worth $127,628 after the 5 years were over. However, if instead you could invest the $100,000 for 5 years at 10% in the S&P 500 and the S&P earned 10%, your $100,000 would grow to $161,051. Now the example gets more dramatic the longer the time that you have to compound the money. So the more years that you can invest, the higher the difference it's going to be between the two. But nonetheless, if you are a younger person, you need more growth in your portfolio. And the other thing about growth is it's going to get a high enough return that it's likely going to outpace inflation. When inflation was at 7% a couple of years ago, a 5% CD was actually losing purchasing power of 2% per year. But if you were able to invest in the S&P 500 and earn 10%, you'd still be earning purchasing power over and above the inflation rate of 7%. And that's why it's important to have a portion of your retirement funds in growth even after you retire, so that it can help you get to higher compounding rates and continue to maintain purchasing power. So a lot of the question about whether a CD is better or a stock ETF is better is based on your risk tolerance, your age, and the number of years that you have to compound. Not all things are right for everyone. People have different objectives for what they're going to spend their money on. And if you need something that's safe and secure, that is guaranteed that it's going to be there, that's more the CD route. If you want something that has more growth, more potential to get your money working harder for you, and maximize how much you can earn on your money, that's something that you would consider putting into something like the S&P 500 index fund. So I hope that clears up the debate of CDs versus growth stocks. Which are better? If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts, where there's a search box and you can search through any topic you can think of. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.